Greetings all and welcome to AlgoFox Academy. In the last two lessons, we saw the properties of options and the pricing of options. In today's class, I am going to take you live to my demat account, show you the option premium pricing and also calculate the values practically. Not only that, I am also going to place orders in options for more clarification. So let's head into my demat account and trade in options live. Alright, so this is my Zerodha account and I am going to trade in options today. Let me just delete everything and start from the scratch. So let us say I will add one script. Let's say ICICI Bank. Just searching for ICICI Bank. I'm also going to add its futures. November future. Now you will see ICICI Bank's spot price is at 910 and the future price is at 915. Now to trade in options, we have to add call and put. If I'm expecting the market to go up, I'm going to buy calls. I can buy call of absolutely any strike. Similarly, if I'm expecting the market to go down, I will buy put, and again I can buy put of any strike. But before we do any buying or selling, I also want to emphasize how the theoretical calculations done in the last classes are valid in the practical live trading also. So I'm just going to add a few strikes here. Let us say ICICI Bank 880 call and 880 put. Then I'm going to add ICICI Bank 890 call and 890 put. Then I'm going to add 900 call and 900 put. Then I'll do it for a few more strikes. 910 call and put, 920 call and put, 930 call and put, and finally 940 call and put. So before I do anything else, I'm just going to arrange call on one side and put on other side. I can simply drag calls above, so puts will automatically come down. So now you will notice that since ICICI Bank is up by 0.56%, you will see all the calls in the Zerodha are also represented in the green. That means they are up. So you can see 880 call is up by 6%, 890 call is up by 10%, so forth and so on. And all the puts are down. 880 put is down by 16%, 890 put is also down by 16%. So all the puts are in red. Okay, I just have to add 940 call also here. All the calls are in green and all the puts are in red. So as we discussed in our last class, if the stock goes up, corresponding call will go up and corresponding puts will go down. Now since all the calls have gone up and all the puts have gone down, if I'm expecting the ICICI Bank to further go up from here, I'll just add the chart. Now if I'm expecting ICICI Bank to further go up from here, I can buy any call, or if I'm expecting it to go down, I can buy any put. But before we buy or sell put, I also want to show you how the values of these calls and puts are derived practically. So you see currently ICICI Bank is at 909, but the future value is 915. Now a lot of people get confused that when we are selecting at the money, which price should we consider? Should we consider the spot price or the equity price, or should we consider the future price? Ideally, to do Black-Scholes calculation, future price will give you much better reference. So our future price is 915. So any strike closer to 915 becomes at the money. But 910 and 920 both are equally close to 915. So both 910 and 920 can be considered as at the money in this case. Now let us understand how the value of these calls and puts are determined practically. So I'm just going to take one Excel sheet, write the value. ICICI Bank is at 915 and I have taken few strikes: 880, 890, 900, 910, 920, 930 and finally 940. On my left hand side, I'm just going to mention all the call premium. On my right hand side, I'm just going to mention all the put premium. Now let us go back here. 880 call is at 43 rupees. You can see it's at 43 rupees. 4343. So I'm just going to write it here as 43. Similarly, I'm just going to fill all the other call and put values from Zerodha. So you can see 35.95, 28.80, then 23, 18, 13 and 10, 18, 13.75, 10.45. Let's go to the put side. Put side, it is 8.25, 11, 14.45, 18.70, 23.70, 29.5 and 35.75. Alright, this is how the prices are visible to me on my Zerodha terminal. So as I said, I can buy any call or any put. It is totally up to me depending upon in which direction I am expecting the market to go up. But before we go ahead, let us discuss how the prices are calculated. So ICICI Bank is at 915. So any strike above 915 for the calls will be out of the money. So 920, 930 and 940, these three strikes will be out of the money for me. So let me just mark, let us say yellow color for them. And similarly, any strike below 915 will be out of the money for put. 890, 890 and 900, these are the put strikes which will become out of the money. And 910 call will become at the money. So I'll just mark it, let us say with green. This will also become at the money. I'll mark it with the green. And the other three strikes will become in the money for call, that is 880, 890 and 900 call will become in the money. We have discussed the definition in our previous classes. You can refer to the previous videos, and here also I'll mark the same color for in the money. Now let us understand how the prices were determined. Firstly, as you know that ATM and OTM only have extrinsic value, they don't have any intrinsic value. So now from 915 to 940 we have a difference of 25 points. So at a difference of 25 rupees the extrinsic value is 10. At a difference of 15, that is the difference between 915 and 930 call is 15 rupees. At the difference of 15 rupees the premium is 13. At the difference of just 5 rupees the difference is 18. Now you will see very clearly how the 23 value is determined. So ICICI Bank is at 915, right? And from 915, 910 is also at 5 rupees difference and 920 is also at 5 rupees difference. But 920 is having an extrinsic value of 18. So naturally 910 will also have an extrinsic value of 18 only. But since 910 becomes partially in the money, the difference of 5 rupees has to be added, because 915 minus 910, the difference of 5 rupees has to be added, and because of this the value goes down to 23 rupees. So you see that whatever theoretical calculations we have seen in the previous class, they are actually tallying up with the practical value that you see on the Zerodha guide. Similarly, 900 call is valued at 18 rupees. How did we derive 18 rupees? So 900 call is at 15 rupees difference from 915. Also 930 call is also at a 15 rupees difference. So it is very obvious that this will also have same premium, that is 13.75, and we can add a difference of 15 rupees here. 15 is the difference because the difference between 900 and 915 is 15. So the sum comes down to around 28.75, but the value is 28.8. There will be slight difference between practical value and theoretical value, but you are getting an idea on what basis the values are calculated. Similarly, if you see 890 call value, it is 35.95. How did we get it as 35.95? 890 call is at a difference of 25 rupees from 915, which is the current market price. And at 25 rupees difference, we also have 940 call. So 940 call has an extrinsic value of 10.45. So just write 10.45 plus add a difference of 25 rupees here, because the difference between 890 call and 915 is 25. The total sum comes down to 35.45, but practical value is 35.95, and that's okay. Similarly, for 880 call, you can guess difference is 35, intrinsic value will be 35, and there will be some extrinsic value. Let us say the extrinsic value is maybe 8, because of which 8 plus 35 is coming down to 43 rupees. So now this is how exactly the values are determined. So you will see that for in the money intrinsic value is getting added up, and for extrinsic value there is just extrinsic value, it is just 13.75 and 10.45. Now how did we derive this 18, 13.75 and 20, 10.45? This is all derived using Black-Scholes calculator. We're going to talk about that in detail as we go ahead in our coming video. But for now, to understand that we have Black-Scholes calculator to calculate extrinsic value. In these extrinsic value, we add intrinsic value, that is the difference between current market price and strike price, and finally we get the premiums that we see on the screen. Now the same logic can be applied for put. In fact, I'll do the same logics for put so that it will be a revision for you. Now 910 call is having a premium of 23 and 920 is having a premium of 18. But on the put side it is reverse. 910 is having a premium of around 18.7 and 920 is having a premium of 23.7. So you see this value and this value is tallying, this value and this value is getting tallied. Similarly, 13.75 and 14.45 are almost same, 10.45 and 11 are almost same, and the premium of 8 that we had calculated and this 8 is almost same. And on other side you will see 28.8 and 29.5 are almost same, 35.95 and 35.75 are almost same. So calls and puts will have same premium as we go up or down depending upon where the current market price is. Now if I have to calculate, you can say this 8.25 is the extrinsic value, 11 is the extrinsic value, and 14.45 is the extrinsic value. Also for 910, 18.7 is purely extrinsic value and nothing else. Now how did we get 23.7 here? The difference between 920 and 915 is 5. So 18.7 is the extrinsic value plus we add 5, that is a difference, so it becomes 23.7. For 930 call, you see that 930 call is at a difference of 15 rupees from 915 and 900 is also at a 15 rupees difference. So we do 14.45, that is extrinsic value, plus an intrinsic value of 15. The sum comes down to 29.45. So again you will see theoretical value and practical values are tallying. Similarly, we'll add 11 rupees extrinsic value here, the same extrinsic value is added up here, plus a difference of 25. So the net, the theoretical value is 36 but practical value is 35.75. So this is how option pricing is done. So I'll go back to my Zerodha account, and instead of adding all the strikes, I can just keep those strikes that I wish to trade in. But the reason I have added all the strike is just to showcase you why are you seeing these values. So next time when you open Zerodha or any other trading account and you put some random strike, you know that these values are not random, they are derived by mathematical formula of intrinsic value plus extrinsic value. Now if I'm expecting ICICI Bank to go up, or if I'm expecting any other stock to go up, I can buy call, and if I'm expecting any stock to go down, I can buy the put. Now for example, let us say I'm going to go to another watch list. In Zerodha I can add up to 7 watch lists. Let us say I'll go to list number 4, delete everything that I have, and I can even trade in indices. Like for example, I can even add Nifty November future. Nifty November future is at 18,096, that is almost around 18,100. And if I feel that Nifty is going to fall down from here, I can just add Nifty 18,000 put. 18,000 put is slightly out of the money because at the money is 18,100. One strike out becomes 18,000 put. So since Nifty has gone down, put has gone up by 6%, and if I'm expecting market to go down from here, I can buy one lot of put here. So I'll just click on buy. When I click on buy, I have two options. One is intraday, other is positional, that is overnight, just like the trading in futures. So here my net margin would be 227.5 into 50, that is the total margin of only 11,000 rupees. So trading in options is very cheap compared to trading in futures. In futures, notice from the previous lessons, we needed around 50,000 rupees to buy one lot of future. In fact, I'm just going to show you. If I want to buy one lot of November future, you will see I actually need 1,10,000 rupees. However, if I want to buy a put, I just need 11,000 rupees, almost 10 times lower price. Now, since I have 11,000 rupees in my account, I can place an order to buy at 227.4. Okay, so now the price actually is at 228.05, but I have placed an order at 227.4. That means whenever the market will come down to 227.4, it will execute, and it is already executed. Now if I go to my positions, you will see the order being open. There was a trade that I had taken yesterday which I booked today, so ignore this Nifty 18,700 call. Currently we have taken 18,000 put at 227.40, and right now it is at 228.40. Now you will see that whenever Nifty will go down, put will go up, and if Nifty will go up, put will go down. Just to show you, I can show you the chart of Nifty futures, and I'll just make this chart, let us say a 5 minutes chart. That means each candle represents a 5 minutes time. So you will see that today market opened like this, went up, and then it has come down. But whereas you will when I open the chart of put, the put chart is reverse, because market went up, put went down. When the market is going down, put is now actually going up. Similarly, if I have to show you the chart of a call, let us say Nifty 18,200 call, you will see the call is exactly moving like futures. Call actually went up. When the Nifty is going down, call is also going down. So as per your analogy, you can place a buy or a sell trade in either call or an put. So I've just taken one put here, and right now it is giving me a loss of close to 25 rupees. I can even set targets and stop loss for this, exactly like how you set targets and stop loss for equities or for futures. And of course I can buy or sell multiple strikes. If I have bought 18,000 put, I can buy even other strikes. For example, I can just go to Nifty 17,800 put. If I want, I can buy this put also. I can just click on buy, and I can even buy this put. Now you will see that I'll be having two puts. One is 18,000 put, other is 17,800 put. I think the order is not placed because I want to buy at 158.35. Right now the price is 158.75. Not only that, I can even buy calls also. For example, if I want to also buy call for Nifty, right? So for example, 18,200 call, which I've already added, I can even simultaneously buy that also by clicking on buy. Now you see I can simultaneously buy multiple calls, multiple puts of different strikes. It is totally up to me for which call to be purchased and which put to be purchased. You see the call is also already purchased, and in put I am getting a decent profit of 200 rupees. As I said, if I want to exit, I can just exit at whatever price I'm comfortable with. And you see, this is how you place trades in options, and this is how you trade in options. So this was a brief introduction about how to do option buying. In our coming classes, we are going to discuss in detail about options and talk about few more concepts associated with it. See you in the next lesson.